Open a ZERODHA account. 2. Technical Analysis Chapter 1. Background Chapter 2. Introducing Technical Analysis Chapter 3. The Chart Types Chapter 4. Getting Started with Candlesticks Chapter 5. Single Candlestick Patterns Part 1 Chapter 6. Single Candlestick Patterns Part 2 Chapter 7. Single Candlestick Patterns Part 3 Chapter 8. Multiple Candlestick Patterns Part 1 Chapter 9. Multiple Candlestick Patterns Part 2 Chapter 10. Multiple Candlestick Patterns Part 3 Chapter 11. The Support and Resistance Chapter 12. Volumes Chapter 13. Moving Averages Chapter 14. Indicators Part 1 Chapter 15. Indicators Part 2 Chapter 16. The Fibonacci Retracements Chapter 17. The Dow Theory Part 1 Chapter 18. The Dow Theory Part 2 Chapter 19. The Finale, Helping You Get Started Chapter 20. Supplementary Notes 1. Download Part 1 includes Chapters 1 to Open a ZERODHA account. Chapter 1. Background. 1.1 Overview. The previous module set us on a good plane with the basic understanding about the stock markets. Taking cues from the previous module, we now know that developing a well-researched point of view is critical for stock market success. A good point of view should have a directional view and should also include information such as price at which one should buy and sell stocks, risk involved, expected reward, expected holding period. Technical analysis, also abbreviated as TA, is a popular technique that allows you to do just that. It not only helps you develop a point of view on a particular stock or index but also helps you define the trade, keeping in mind the entry, exit and risk perspective. Like all research techniques, technical analysis also comes with its own attributes, some of which can be highly complex. However, technology makes it easy to understand. We will discover these attributes as we proceed along this module. 1.2 Technical Analysis. What is it? Consider this analogy. Imagine you are vacationing in a foreign country where everything, including the language, culture, climate, and food, is new to you. On day 1, you do the regular touristy activities. And by evening you are very hungry. You want to end your day by having a great dinner. You ask around for a good restaurant and you are told about a nice food street which is close by. You decide to give it a try. To your surprise, there are many vendors selling different varieties of food. Everything looks different and interesting. You are absolutely clueless as to what to eat for dinner. To add to your dilemma, you cannot ask around as you do not know the local language. So given all this, how will you make a decision on what to eat? Well, you have 2 options to figure out what to eat. Option 1. You visit a vendor. Figure out what they are cooking, selling. Check on the ingredients used, cooking style. Probably taste a bit and figure out if you actually like the food. You repeat this exercise across a few vendors, after which you would most likely end up eating at a place that satisfies you the most. The advantage with this technique is that you know exactly what you are eating since you have researched about it on your own. However, on the flip side, the methodology you adopted is not really scalable as there could be about 100 odd vendors. And with limited time at your disposal, you can probably cover about 4 or 5 vendors. Hence, there is a high probability that you could have missed the best tasting food on the street. Option 2. You just stand in a corner and observe all the vendors. You try and find a vendor who is attracting the maximum crowd. Once you find such a vendor, you make a simple assumption: the vendor is attracting so many customers, which means he must be making the best food. Based on your assumption and the crowd's preference, you decide to go to that particular vendor for your dinner. Chances are that you could be eating the best tasting food available on the street. The advantage of this method is the scalability. You just need to spot the vendor with the maximum number of customers and bet on the fact that the food is good based on the crowd's preference. However, On the flip side, the crowd need not always be right. If you could recognize. Option 1 is very similar to fundamental analysis, where you research about a few companies thoroughly. We will explore about fundamental analysis in greater detail in the next module. Option 2 is very similar to technical analysis, where one scans for opportunities based on the current trend, aka the preference of the market. Technical analysis is a research technique to identify trading opportunities in market based on the actions of market participants. The actions of market's participants can be visualized by means of a stock chart. Over time, patterns are formed within these charts, and each pattern conveys a certain message. The job of a technical analyst is to identify these patterns and develop a point of view. Like any research technique, technical analysis stands on a bunch of assumptions. As a practitioner of technical analysis, you need to trade the markets keeping these assumptions in perspective. Of course, we will understand these assumptions in details as we proceed along. Also, at this point it makes sense to throw some light on a matter concerning FA and TA. Often people get into the argument contending a particular research technique is a better approach to market. However, in reality there is no such thing as the best research approach. Every research method has its own merits and demerits. It would be futile to spend time comparing TA and FA in order to figure out which is a better approach. Both the techniques are different and not comparable. In fact, a prudent trader would spend time educating himself on both the techniques so that he can identify great trading or investing opportunities. 1.3 Setting expectations. Often market participants approach technical analysis as a quick and easy way to make a windfall gain in the markets. On the contrary, technical analysis is anything but quick and easy. Yes, if done right, a windfall gain is possible, but in order to get to that stage one has to put in the required effort to learn the technique. If you approach TA as a quick and easy way to make money in markets, trading catastrophe is bound to happen. When a trading debacle happens, more often than not the blame is on technical analysis and not on the trader's inability to efficiently apply technical analysis to markets. Hence, before you start delving deeper into technical analysis, it is important to set expectations on what can and cannot be achieved with technical analysis. Trades. TA is best used to identify short-term trades. Do not use TA to identify long-term investment opportunities. Long-term investment opportunities are best identified using fundamental analysis. Also, if you are a fundamental analyst, use TA to calibrate the entry and exit points. Return per trade. TA-based trades are usually short-term in nature. Do not expect huge returns within a short duration of time. The trick with being successful with TA is to identify frequent short-term trading opportunities, which can give you small but consistent profits. Holding period. Trades based on technical analysis can last anywhere between few minutes and few weeks, and usually not beyond that. We will explore this aspect when we discuss the topic on time frames. Risk. Often traders initiate a trade for a certain reason. However, in case of an adverse movement in the stock, the trade starts making a loss. Usually in such situations, traders hold on to their loss-making trade with the hope they can recover the loss. Remember, TA-based trades are short-term. In case the trade goes sour, do remember to cut the losses and move on to identify another opportunity. Key takeaways from this chapter. Technical analysis is a popular method to develop a point of view on markets. Besides, TA also helps in identifying entry and exit points. Technical analysis visualizes the actions of market participants in the form of stock charts. Patterns are formed within the charts, and these patterns help a trader identify trading opportunities. TA works best when we keep a few core assumptions in perspective. TA is used best to identify short-term trades. 80. Open a ZERODHA account. Chapter 2. Introducing Technical Analysis. 2.1 Overview. In the previous chapter we briefly understood what technical analysis was all about. In this chapter we will focus on the versatility and the assumptions of technical analysis. 2.2 Application on asset types. Probably one of the greatest versatile features of technical analysis is the fact you can apply TA on any asset class as long as the asset type has historical time series data. Time series data in technical analysis context is information pertaining to the price variables, namely open, high, low, close, volume, etc. Here is an analogy that may help. Think about learning how to drive a car. Once you learn how to drive a car, you can literally drive any type of car. Likewise, you only need to learn technical analysis once. Once you do so, you can apply the concept of TA on any asset class, equities, commodities, foreign exchange, fixed income, etc. This is also probably one of the biggest advantages of TA when compared to the other fields of study. For example, when it comes to fundamental analysis of equity, one has to study the profit and loss, balance sheet, and cash flow statements. However, fundamental analysis for commodities is completely different. If you are dealing with agricultural commodity like coffee or pepper, then the fundamental analysis includes analyzing rainfall, harvest, demand, supply, inventory, etc. However, the fundamentals of metal commodities are different. So is for energy commodities. So every time you choose a commodity, the fundamentals change. However, the concept of technical analysis will remain the same irrespective of the asset you are studying. For example, an indicator such as moving average convergence divergence (MACD) or relative strength index (RSI) is used exactly the same way on equity, commodity, or currency. 2.3 Assumption in technical analysis. Unlike fundamental analysts, technical analysts don't care whether a stock is undervalued or overvalued. In fact, the only thing that matters is the stock's past trading data, price and volume, and what information this data can provide about the future movement in the security. Technical analysis is based on few key assumptions. One needs to be aware of these assumptions to ensure the best results. 1. Markets discount everything. This assumption tells us that all known and unknown information in the public domain is reflected in the latest stock price. For example, there could be an insider in the company buying the company's stock in large quantity in anticipation of a good quarterly earnings announcement. While he does this secretively, the price reacts to his actions, thus revealing to the technical analyst that this could be a good buy. 2. The how is more important than why. This is an extension to the first assumption. Going with the same example as discussed above, the technical analyst would not be interested in questioning why the insider bought the stock as long as he knows how the price reacted to the insider's action. 3. Price moves and trend. All major moves in the market is an outcome of a trend. The concept of trend is the foundation of technical analysis. For example, the recent upward movement in the Nifty index to 7,700 from 6,400 did not happen overnight. This move happened in a phased manner, in over 11 months. Another way to look at it is, once the trend is established, the price moves in the direction of the trend. 4. History tends to repeat itself. In the technical analysis context, the price trend tends to repeat itself. This happens because the market participants consistently react to price movements in a remarkably similar way, each and every time the price moves in a certain direction. For example, in uptrending markets, market participants get greedy and want to buy irrespective of the high price. Likewise, in a downtrend, market participants want to sell irrespective of the low and unattractive prices. This human reaction ensures that the price history repeats itself. 2.4 The trade summary. The Indian stock market is open from 9:15 a.m. to 3:30 p.m. During the 6-hour 15-minute market session, there are millions of trades that take place. Think about an individual stock. Every minute there is a trade that gets executed on the exchange. The question is, As a market participant, do we need to keep track of all the different price points at which a trade is executed? To illustrate this further, let us consider this imaginary stock in which there are many trades. Look at the picture below. Each point refers to a trade being executed at a particular time. If one manages to plot a graph which includes every second from 9:15 a.m. to 3:30 p.m., the graph will be cluttered with many points. Hence, in the chart below, for ease of understanding, I've plotted a limited timescale period. Market opened at 9:15 a.m. and closed at 3:30 p.m., during which there were many trades. It will be practically impossible to track all these different price points. In fact, what one needs is a summary of the trading action and not really the details on all the different price points. By tracking the open, high, low and close, we can draw a summary of the price action. The open, when the market's open for trading. The first price at which a trade executes is called the opening price. The high, this represents the highest price at which the market participants were willing to transact for the given day. The low, this represents the lowest level at which the market participants were willing to transact for the given day. The close price is the most important price because it is the final price at which the market closed for a particular period of time. The close serves as an indicator for the intraday strength. If the close is higher than the open, then it is considered a positive day, else negative. Of course, we will deal with this in a greater detail as we progress through the module. The closing price also shows the market sentiment and serves as a reference point for the next day's trading. For these reasons, closing price is more important than the open, high or low prices. The open, high, low, close prices are the main data points from the technical analysis perspective. Each of these prices have to be plotted on the chart and analyzed. Key takeaways from this chapter. Technical analysis is not bound by its scope. The concepts of TA can be applied across any asset class as long as it has a time series data. TA is based on few core assumptions. Markets discount everything. The how is more important than why. Price moves and trends. History tends to repeat itself. A good way to summarize the daily trading action is by marking the open, high, low and close prices, usually abbreviated as OHLC. Open a ZERODHA account. Chapter 3. The chart types. 3.1 Overview. Having recognized that the open O, high H, low L, and close C serves as the best way to summarize the trading action for the given time period, we need a charting technique that displays this information in the most comprehensible way. If not for a good charting technique, charts can get quite complex. Each trading day has 4 data points, i.e. the OHLC. If we are looking at a 10-day chart, we need to visualize 40 data points, 1 day x 4 data points per day. So you can imagine how complex it would be to visualize 6 months or a year's data. As you may have guessed, the regular charts that we are generally used to, like the column chart, pie chart, area chart, etc., does not work for technical analysis. The only exception to this is the line chart. The regular charts don't work mainly because they display 1 data point at a given point in time. However, technical analysis requires 4 data points to be displayed at the same time. Below are some of the chart types. Line chart, bar chart, Japanese candlestick. The focus of this module will be on the Japanese candlesticks. However, before we get to candlesticks, we will understand why we don't use the line and bar chart. 3.2 The line and bar chart. The line chart is the most basic chart type and it uses only 1 data point to form the chart. When it comes to technical analysis, a line chart is formed by plotting the closing prices of a stock or an index. A dot is placed for each closing price and the various dots are then connected by a line. If we are looking 60-day data, then the line chart is formed by connecting the dots of the closing prices for 60 days. The line charts can be plotted for various time frames, namely monthly, weekly, hourly, etc. So, if you wish to draw a weekly line chart, You can use weekly closing prices of securities and likewise for the other time frames as well. The advantage of the line chart is its simplicity. With one glance, the trader can identify the generic trend of the security. However, the disadvantage of the line chart is also its simplicity. Besides giving the analysts a view on the trend, the line chart does not provide any additional detail. Plus, the line chart takes into consideration only the closing prices, ignoring the open, high and low. For this reason, traders prefer not to use the line charts. The bar chart, on the other hand, is a bit more versatile. A bar chart displays all the four price variables, namely open, high, low, and close. A bar has three components. The central line, the top of the bar, indicates the highest price the security has reached. The bottom end of the bar indicates the lowest price for the same period. The left mark, tick, indicates the open. The right mark, tick, indicates the close. For example, assume the OHLC data for a stock as follows. Open 65, high 70, low 60, close 68. For the above data, the bar chart would look like this. As you can see, in a single bar, we can plot 4 different price points. If you wish to view 5 days chart, as you would imagine, we will have 5 vertical bars, so on and so forth. Note the position of the left and right mark on the bar chart varies based on how the market has moved for the given day. If the left mark, which represents the opening price, is placed lower than the right mark, it indicates that the close is higher than the open, close greater than open. Hence a positive day for the markets. For example, consider this. O equals 46. H equals 51. L equals 45. C equals 49. To indicate it is a bullish day, the bar is represented in blue color. Likewise, if the left mark is placed higher than the right mark, it indicates that the close is lower than the open, close less than open. Hence a negative day for markets. For example, consider this. O equals 74. H equals 76. L equals 70. C equals 71. To indicate it is a bearish day, the bar is represented in red color. The length of the central line indicates the range for the day. A range can be defined as the difference between the high and low. Longer the line, bigger the range. Shorter the line, smaller is the range. While the bar chart displays all the 4 data points, it still lacks a visual appeal. This is probably the biggest disadvantage of a bar chart. It becomes really hard to spot potential patterns brewing when one is looking at a bar chart. The complexity increases when a trader has to analyze multiple charts during the day. Hence, for this reason, the traders do not use bar charts. However, it is worth mentioning that there are traders who prefer to use bar charts. But if you are starting fresh, I would strongly recommend the use of Japanese candlesticks. Candlesticks are the default option for the majority in the trading community. 3.3 History of the Japanese Candlestick. Before we jump in, it is worth spending time to understand and brief the history of the Japanese candlesticks. As the name suggests, the candlesticks originated from Japan. The earliest use of candlesticks dates back to the 18th century by a Japanese rice merchant named Homamune Hisa. Though the candlesticks have been in existence for a long time in Japan, and are probably the oldest form of price analysis, the Western world traders were clueless about it. It is believed that sometime around 1980s a trader named Steve Nissen accidentally discovered candlesticks, and he actually introduced the methodology to the rest of the world. He authored the first ever book on candlesticks titled Japanese Candlestick Charting Techniques, which is still a favorite amongst many traders. Most of the pattern in candlesticks still retains the Japanese names, thus giving an oriental feel to technical analysis. 3.4 Candlestick Anatomy. While in a bar chart, the open and the close prices are shown by a tick on the left and the right sides of the bar respectively. However, in a candlestick, the open and close prices are displayed by a rectangular body. In a candlestick chart, candles can be classified as a bullish or bearish candle, usually represented by blue, green, white, and red, black candles respectively. Needless to say, the colors can be customized to any color of your choice. The technical analysis software allows you to do this. In this module, we have opted for the blue and red combination to represent bullish and bearish candles respectively. Let us look at the bullish candle. The candlestick, like a bar chart, is made of three components. The central real body, the real body, rectangular in shape, connects the opening and closing price. Upper shadow connects the high point to the close. Lower shadow connects the low point to the open. Have a look at the image below to understand how a bullish candlestick is formed. This is best understood with an example. Let us assume the price is as follows. Open equals 62. High equals 70. Low equals 58. Close equals 67. Likewise, the bearish candle also has three components. The central real body, the real body, rectangular in shape, which connects the opening and closing price. However, the opening is at the top end and the closing is at the bottom end of the rectangle. Upper shadow connects the high point to the open. Lower shadow connects the low point to the close. This is how a bearish candle would look like. This is best understood with an example. Let us assume the price is as follows. Open equals 456. High equals 470. Low equals 420. Close equals 435. Here is a little exercise to help you understand the candlestick pattern better. Try and plot the candlesticks for the given data. Day open, high, low, close. Day 1,430,444,425,438. Day 2,445,455,438,450. Day 3,445,455,430,437. If you find any difficulty in doing this exercise, feel free to ask your query in the comments at the end of this chapter. Once you internalize the way candlesticks are plotted, reading the candlesticks to identify patterns becomes a lot easier. This is how the candlestick chart looks like if you were to plot them on a time series. The blue candle indicates bullishness and red indicates bearishness. Also note, a long-bodied candle depicts strong buying or selling activity. A short-bodied candle depicts less trading activity and hence less price movement. To sum up, candlesticks are easier to interpret in comparison to the bar chart. Candlesticks help you to quickly visualize the relationship between the open and close as well as the high and low price points. 3.5a Note on time frames. A time frame is defined as the time duration during which one chooses to study a particular chart. Some of the popular time frames that technical analysts use are monthly charts, weekly charts, daily or end-of-day charts, intraday charts, 30 minutes, 15 minutes and 5 minutes. One can customize the time frame as per their requirement. For example, a high-frequency trader may want to use a 1-minute chart as opposed to any other time frame. Here is a quick note on different types of time frames. Time frame: open, high, low, close, no of candles. Monthly: the opening price on the first day of the month, highest price at which the stock traded during the entire month, lowest price at which the stock traded during the entire month, the closing price on the last day of the month, 12 candles for the entire year. Weekly: Monday is opening price, highest price at which the stock traded during the entire week, lowest price at which the stock traded during the entire week, the closing price on Friday, 52 candles for the entire year. Daily or EOD: opening price of the day, highest price at which the stock traded during the day, lowest price at which the stock traded during the entire day, the closing price of the day, 1 candle per day. 252 candles for the entire year. Intraday: 30 minutes, the opening price at the beginning of the first minute, highest price at which the stock traded during the 30-minute duration, lowest price at which the stock traded during the 30-minute duration, the closing price as on the 30th minute, approximately 12 candles per day. Intraday: 15 minutes, the opening price at the beginning of the first minute, highest price at which the stock traded during the 15-minute duration, lowest price at which the stock traded during the 15-minute duration, the closing price as on the 15th minute, 25 candles per day. Intraday: 5 minutes, the opening price at the beginning of the first minute, highest price at which the stock traded during the 5-minute duration, lowest price at which the stock traded during the 5-minute duration, the closing price as on the 5th minute, 75 candles per day. As you can see from the table above, as and when the time frame reduces, the number of candles, data points, increase. Based on the type of trader you are, you need to take a stand on the time frame you need. The data can either be information or noise. As a trader, you need to filter information from noise. For instance, a long-term investor is better off looking at weekly or monthly charts, as this would provide information. While on the other hand, an intraday trader executing 1 or 2 trades per day is better off looking at end-of-day EOD or at best 15 minutes charts. Likewise, for a high-frequency trader, a 1-minute charts can convey a lot of information. So based on your stance as a trader, you need to choose a time frame. This is extremely crucial for your trading success, because a successful trader looks for information and discards the noise. Key takeaways from this chapter. Conventional chart type cannot be used for technical analysis, as we need to plot 4 data points simultaneously. Line chart can be used to interpret trends, but besides that, no other information can be derived. Bar charts lacks visual appeal and one cannot identify patterns easily. For this reason, bar charts are not very popular. There are 2 types of candlesticks, bullish candle and bearish candle. The structure of the candlestick, however, remains the same. When close greater than open equals, it is a bullish candle. When close less than open equals, it is a bearish candle. Time frames play a very crucial role in defining the trading success. One has to choose this carefully. The number of candle increases as and when the frequency increases. A trader should be in a position to discard noise from relevant information. 104 responses to the chart types. Open a ZERODHA account. Chapter 4. Getting started with candlesticks. 4.1 History tends to repeat itself, the big assumption. As mentioned earlier, one of the key assumptions in technical analysis is that we rely on the fact that the history tends to repeat itself. This probably is one of the most important assumptions in technical analysis. It would make sense to explore this assumption in greater detail at this juncture, as candlestick patterns are heavily dependent on it. Assume today, the 7th of July 2014, there are few things happening in a particular stock. Let us call this factor. Factor 1. The stock has been falling for the last 4 consecutive trading sessions. Factor 2. Today, the 7th of July 2014, is the 5th session and the stock is falling on relatively lower volumes. Factor 3. The range in which the stock trades today is quite small compared to the last 4 days. With these factors are playing in the background, let us assume that on the next day, the 8th of July 2014, the fall in stock gets arrested and in fact the stock rallies towards a positive close. So, as an outcome of the 3 factors, the stock went up on the 6th day. Time passes and let's say after a few months, the same set of factors is observed for 5 consecutive trading sessions. What would you expect for the 6th day? According to the assumption, history tends to repeat itself. However, we need to make an addendum to this assumption. When a set of factors that has panned out in the past tends to repeat itself in the future, we expect the same outcome to occur as was observed in the past, provided the factors are the same. Therefore, based on this assumption, even this time round we can expect the stock price to go up on the 6th trading session. 4.2 Candlestick patterns and what to expect. The candlesticks are used to identify trading patterns. Patterns in turn help the technical analyst to set up a trade. The patterns are formed by grouping 2 or more candles in a certain sequence. However, sometimes powerful trading signals can be identified by just single candlestick pattern. Hence, candlesticks can be broken down into single candlestick pattern and multiple candlestick patterns. Under the single candlestick pattern, we will be learning the following: Marui BOSU, bullish Marui BOSU, bearish Marui BOSU, doji, spinning tops, paper umbrella, hammer, hanging man, shooting star. Multiple candlestick patterns are a combination of multiple candles. Under the multiple candlestick patterns we will learn the following. Engulfing pattern, bullish engulfing, bearish engulfing, harami, bullish harami, bearish harami, piercing pattern, dark cloud cover, morning star, evening star. Of course you must be wondering what these names mean. As I had mentioned in the previous chapter, some of the patterns retained the original Japanese name. Candlestick patterns help the trader develop a complete point of view. Each pattern comes with an inbuilt risk mechanism. Candlesticks gives an insight into both entry and stop loss price. 4.3 Few assumptions specific to candlesticks. Before we jump in and start learning about the patterns, there are a few more assumptions that we need to keep in mind. These assumptions are specific to candlesticks. Do pay a lot of attention to these assumptions as we will keep referring back to these assumptions quite often later. At this stage, these assumptions may not be very clear to you. I will explain them in greater detail as and when we proceed. However, do keep these assumptions in the back of your mind. Buy strength and sell weakness. Strength is represented by a bullish blue candle and weakness by a bearish red candle. Hence, whenever you are buying, ensure it is a blue candle day, and whenever you are selling, ensure it's a red candle day. Be flexible with patterns, quantify and verify. While the textbook definition of a pattern could state a certain criteria, there could be minor variations to the pattern owing to market conditions. So one needs to be a bit flexible. However, one needs to be flexible within limits, and hence it is required to always quantify the flexibility. Look for a prior trend if you are looking at a bullish pattern. The prior trend should be bearish, and likewise if you are looking for a bearish pattern, the prior trend should be bullish. In the next chapter, we will begin with learning about single candlestick patterns. Key takeaways from this chapter. History tends to repeat itself. We modified this assumption by adding the factor angle. Candlestick patterns can be broken down into single and multiple candlestick patterns. There are 3 important assumptions specific to candlestick patterns. Buy strength and sell weakness. Be flexible, quantify and verify. Look for a prior trend. 9. Open a ZERODHA account. Chapter 5. Single Candlestick Patterns Part 1. 5.1 Overview. As the name suggests, a single candlestick pattern is formed by just one candle. So as you can imagine, the trading signal is generated based on one day's trading action. The trades based on a single candlestick pattern can be extremely profitable provided the pattern has been identified and executed correctly. One needs to pay some attention to the length of the candle while trading based on candlestick patterns. The length signifies the range for the day. In general, the longer the candle, the more intense is the buying or selling activity. If the candles are short, it can be concluded that the trading action was subdued. The following picture gives a perspective on the long, short, bullish, and bearish candle. The trades have to be qualified based on the length of the candle as well. One should avoid trading based on subdued short candles. We will understand this perspective as and when we learn about specific patterns. 5.2 The Marui BOSU. The Marui BOSU is the first single candlestick pattern that we will understand. The word Marui BOSU means bald in Japanese. We will understand the context of the terminology soon. There are 2 types of Marui BOSU, the bullish Marui BOSU and the bearish Marui BOSU. Before we proceed, let us lay down the 3 important rules pertaining to candlesticks. We looked at it in the previous chapter. I've reproduced the same for quick reference. Buy strength and sell weakness. Be flexible with patterns, verify and quantify. Look for prior trend. Marui BOSU is probably the only candlestick pattern which violates rule number 3, i.e. look for prior trend. A Marui Buzo can appear anywhere in the chart irrespective of the prior trend. The trading implication remains the same. The textbook defines Marui BOSU as a candlestick with no upper and lower shadow, therefore appearing bald. A Marui Buzo has just the real body as shown below. However, there are exceptions to this. We will look into these exceptions shortly. The red candle represents the bearish Marui Buzo and the blue represents the bullish Marui Buzo. 5.3 Bullish Marui Buzo. The absence of the upper and lower shadow in a bullish Marui Buzo implies that the low is equal to the open and the high is equal to the close. Hence, whenever the open equals low and high equals close, a bullish Marui Buzo is formed. A bullish Marui Buzo indicates that there is so much buying interest in the stock that the market participants were willing to buy the stock at every price point during the day. So much so that the stock closed near its high point for the day. It does not matter what the prior trend has been. The action on the Marui Buzo day suggests that the sentiment has changed in the stock and now bullish. The expectation is that with this sudden change in sentiment there is a surge of bullishness and this bullish sentiment will continue over the next few trading sessions. Hence, a trader should look at buying opportunities with the occurrence of a bullish Marui Buzo. The buy price should be around the closing price of the Marui Buzo. In the chart above, a CC Limited. The encircled candle is a bullish Marui Buzo. Notice the bullish Marui Buzo candle does not have a visible upper and a lower shadow. The OHLC data for the candle is open equals 971.8, high equals 1030.2, low equals 970.1, close equals 1028.4. Please notice, as per the textbook definition of a Marui Buzo, open equals low and high equals close. However, in reality there is a minor variation to this definition. The variation in price is not much when measured in percentage terms. For example, the variation between high and close is 1.8, which as a percentage of high is just 0.17%. This is where the second rule applies: be flexible, quantify and verify. With this occurrence of a Marui Buzo, the expectation has turned bullish and hence one would be a buyer of the stock. The trade setup for this would be as follows. Buy price equals around 1028.4 and stop loss equals 970.0. As it is evident, candlestick patterns do not give us a target. However, we will address the issue of setting targets at a later stage in this module. Having decided to buy the stock, when do we actually buy the stock? The answer to this depends on your risk appetite. Let us assume there are two types of trader with different risk profiles, the risk taker and the risk averse. The risk taker would buy the stock on the same day as the Marui Buzo is being formed. However, the trader needs to validate the occurrence of a Marui Buzo. Validating is quite simple. Indian markets close at 3:30 p.m. So, around 3:20 p.m. one needs to check if the current market price, CMP, is approximately equal to the high price for the day, and the opening price of the day is approximately equal to the low price the day. If this condition is satisfied, then you know the day is forming a Marui Buzo and therefore you can buy the stock around the closing price. It is also very important to note that the risk taker is buying on a bullish blue candle day, thereby following rule 1, i.e. buy on strength and sell on weakness. The risk-averse trader would buy the stock on the next day, i.e. the day after the pattern has been formed. However, before buying, the trader needs to ensure that the day is a bullish day to comply with the rule number 1. This means the risk-averse buyer can buy the stock only around the close of the day. The disadvantage of buying the next day is that the buy price is way above the suggested buy price, and therefore the stop loss is quite deep. However, as a trade-off, the risk-averse trader is buying only after doubly confirming that the bullishness is indeed established, as per the ACC's chart above. Both the risk-taker and the risk-averse would have been profitable in their trades. Here is another example, Asian Paints Limited, where both the risk-taker and the risk-averse trader would have been profitable. Here is an example where the risk-averse trader would have benefited. Notice in the chart above, A bullish Marui Buzo has been encircled. The risk taker would have initiated a trade to buy the stock on the same day around the close, only to book a loss on the next day. However, the risk-averse would have avoided buying the stock entirely because the next day happened to be a red candle day. Going by the rule, we should buy only on a blue candle day and sell on a red candle day. 5.4 The stop loss on bullish Marui Buzo. What if after buying, the market reverses its direction and the trade goes wrong? Like I had mentioned earlier, candlestick patterns comes with an inbuilt risk management mechanism. In case of a bullish Marui Buzo, the low of the stock acts as a stop loss. So after you initiate a buy trade, in case the market moves in the opposite direction, you should exit the stock if price breaches the low of the Marui Buzo. Here is an example where the bullish Marui Buzo qualified as a buy for both the risk-averse and the risk taker. The OHLC is O equals 960.2, H equals 988.6, L equals 959.85, C equals 988.5. But the pattern eventually failed and one would have booked a loss. The stop loss for this trade would be the low of Marui Buzo, i.e. 959.85. Booking a loss is a part of the game. Even a seasoned trader goes through this. However, the best part of following the candlestick is that the losses are not allowed to run indefinitely. There is a clear agenda as to what price one has to get out of a trade provided the trade starts to move in the opposite direction. In this particular case, booking a loss would have been the most prudent thing to do as the stock continued to go down. Of course, there could be instances where the stop loss gets triggered and you pull out of the trade. But the stock could reverse direction and start going up after you pulled out of the trade. But unfortunately, this is also a part of the game and one cannot really help it. No matter what happens, the trader should stick to the rules and not find excuses to deviate from it. 5.3 Bearish Marui Buzo. Bearish Marui Buzo indicates extreme bearishness. Here the open is equal to the high and close is equal to low. Open equals high, and close equals low. A bearish Marui Buzo indicates that there is so much selling pressure in the stock that the market participants actually sold at every price point during the day. So much so that the stock closed near its low point of the day. It does not matter what the prior trend has been. The action on the Marui Buzo day suggests that the sentiment has changed and the stock is now bearish. The expectation is that this sudden change in sentiment will be carried forward over the next few trading sessions, and hence one should look at shorting opportunities. The sell price should be around the closing price of the Marui Buzo. In the chart above BPCL Limited, the encircled candle indicates the presence of a bearish Marui Buzo. Notice the candle does not have an upper and a lower shadow. The OHLC data for the candle is as follows. Open equals 355.4. High equals 356.0. Low equals 341. Close equals 341.7. As we had discussed earlier, a minor variation between the OHLC figures leading to small upper and lower shadows is okay as long as it is within a reasonable limit. The trade on the bearish Marui Buzo would be to short BPCL approximately at 341.7 with a stop loss at the high point of the candle. In this case, the stop loss price is 356.0. Of course, at this stage we still haven't dealt with setting targets, and we will figure that out much later in this module. Do remember this. Once a trade is initiated, you should hold on to it until either the target is hit or the stop loss is breached. If you attempt to do something else before any one of these event triggers, then most likely your trade could go bust. So staying on course of the plan is extremely crucial. Trade can be initiated based on the risk appetite of the person. The risk taker can initiate a short trade on the same day around the closing. Of course, he has to make sure that the candle is forming a bearish Marui Buzo. To do this at 3:20 p.m., the trader has to confirm if the open is approximately equal to the high and the current market price is equal to the low price. If the condition is validated, then it is a bearish Marui Buzo and hence a short position can be initiated. If the trader is risk-averse, he can wait till the next day's closing. The short trade will go through only by 3:20 p.m. next day after ensuring that the day is a red candle day. This is also to ensure that we comply with first rule, buy strength and sell weakness. In the BPCL chart above, both risk-taker and risk-averse would have been profitable. Here is another chart, Stipple Limited, where the bearish Marui Buzo has been profitable for both risk-taker and a risk-averse trader. Remember, these are short-term trades and one needs to be quick in booking profits. Here is a chart which show bearish Marui Buzo pattern which would have not worked out for the risk-taker, but a risk-averse trader would have entirely avoided initiating the trade, thanks to Rule 1.5.4, the trade trap. Earlier in this chapter we did discuss about the length of the candle. One should avoid trading during an extremely small, below 1% range, or long candle, above 10% range. A small candle indicates subdued trading activity and hence it would be difficult to identify the direction of the trade. On the other hand, a long candle indicates extreme activity. The problem with lengthy candles would be the placement of stop loss. The stop loss would be deepened in case the trade goes wrong. The penalty to pay would be painful. For this reason, one should avoid trading on candles that are either too short or too long. Key takeaways from this chapter. Remember the rules based on which candlesticks work. Marui Buzo is the only pattern which violates rule number 3, i.e. look for prior trend. A bullish Marui Buzo indicates bullishness. Buy around the closing price of a bullish Marui Buzo. Keep the low of the Marui Buzo as the stop loss. A bearish Marui Buzo indicates bearishness. Sell around the closing price of a bearish Marui Buzo. Keep the high of the Marui Buzo as the stop loss. An aggressive trader can place the trade on the same day as the pattern forms. Risk-averse traders can place the trade on the next day after ensuring that it obeys rule number 1, i.e. buy strength and sell weakness. An abnormal candle lengths should not be traded. Short candle indicates subdued activity. Long candle indicates extreme activity. However, placing stop loss becomes an issue.